Hello and welcome to another edition of the Crypto Club and Digital Assets Weekly Catch-Up on Zoom. It is Sunday, the 16th of February, 2025, and as is always the case, never quite know what we're going to be talking about. So let's go straight in, see who's here, and see what we're going to discuss today. Hey, Stuart, Mark, Gabrielle, all the regulars. Excellent. Welcome back. Hey, so Mark, good evening to you, or good morning, depending on where you are in the world.
No, I'm in London, just getting a train back. So.
Excellent. Welcome for joining us. And got Gabriella as well. Hey, Gabriella, presume how's things in sunny Madrid?
Yes, hello, everyone.
And we've just been joined by Annie as well. Hello, Annie, another of our regulars.
Hello.
Nice to see you back again. Excellent. So we're just all waking up at the moment as everyone logs in, connects, makes sure everything's working. I don't know if there's anything anyone wants to begin talking about straight away, anything hot news or anything. Meme coins with Argentina's president launching Libra, which rocketed up and collapsed down, was probably in the news last week. Anything anyone wants to discuss to begin with this week?
Yes, so that Libra one's an interesting one. It was a new one on me. Was it backed against something or just a straight coin?
I don't even know. All I know is that the president of Argentina was backing it, and it got launched, and it did the fairly standard thing of went up quite quickly, and then collapsed back down again. So, well, I don't know the background to it. I don't know if it was meant to be an asset-backed one, but I would doubt it somehow. But as it shows the ease with which these things get created. I saw an article in the press the other day. Well, that was saying how many thousand new cryptocurrencies have been created. And I think the reality is it's not actually thousands of cryptocurrencies, it's thousands of tokens that are being created. And tokens and cryptocurrencies aren't quite the same. But certainly it looks like there's a lot of activity. The ability to mint a token or something is relatively easy now, and everyone seems to be doing it and launching it. So yeah, interesting stuff. So, welcome back, Stuart.
Thank you. It just seems to be how it. Sorry, it just seems to be how it's marketed, really, Gary, isn't it? I've seen like the Trump ones, and that you get a big enough footprint on your marketing, you get some phenomenal people jumping in, don't you?
You're exactly right. So a lot of it is around kind of like celebrity endorsement in some way. You know, and certainly if that celebrity is Elon Musk. And, you know, any time he used to post a picture of a dog, basically Dogecoin would go down sideways. Then you had Trump coin and Melania coin, where they're obviously, you know, linked into quite well-known people. But you get all sorts like that. It's kind of quite funny in a way, because it shows just how shallow the market is, to be honest.
Yeah.
You know, people can create these things. I don't understand what do others think, Mark?
Well, I don't understand why people buy into it, really. I'm still trying to... if there's still no value to them, is there? It's not backed by anything. It just seems a bit bizarre, really, that they get such phenomenal take-up.
Yeah, so, I mean, my opinion, and welcome others to join in on this as well, I've said this all along about a lot of the crypto market, is that it's a little bit like Pokemon cards in the school playground. You know, Pokemon cards are all made of the same material, slightly different pictures or drawings or whatever. They hold no absolute intrinsic value. They're not backed by anything. They don't represent a store of value or anything. However, some of them go up in price in the school playground, you know, because the rarity value or people want to collect them. Crypto's no different. It's just on a bigger scale with a lot more zeros. I don't know. What do other people think?
Gary, I think you just contradicted yourself where you said it had no intrinsic value. Yeah. Of course it has intrinsic value. You know, if I'm swapping a Pokemon card and you want it, it's got value to you.
But that's not an intrinsic value, is it? That's a market value.
Well, it's a market value, but when we started trading seashells, you know, is that a market value or is it intrinsic value? Because I knew the second day I came along to swap seashells with you for a fish, it had a value. You wanted four of my seashells.
But that's a commodity, though, isn't it? That's different. They're all physical commodities.
No, it isn't until it becomes generally used. I mean, Gary may collect seashells, and he may fish off the pier, and I come along, and it's not a commodity at that point, because if Annie comes along and says, "Can I do it?" then it might become a commodity, and you come along, Mark. But until then, it's got an intrinsic value to me because I know I can get a fish for two clamshells or whatever.
So this is where maybe it's my definitions type thing that I think of intrinsic value. When we think about like share prices of companies, for example, the intrinsic value is in the company that's behind those shares. So the shares that it represents, the assets that they hold, customers they have, the business they operate, and the money they have in the bank. So to me, seashells hold no intrinsic value because they're simply used as a means of exchange. So it is, as you say, you know, using them to buy, sell fish or whatever, but they're not actually backed by fish as such. Whereas something like gold gets more interesting because gold has a value in its own right.
No, it doesn't. No, it doesn't.
You think
it's
no?
a value. No, it's a value we've assigned to it. It's a dumb metal, and we've said it's something that the emperors and everyone who was rich decided to gild themselves with, but it has no value as such.
Well, it's something that you use
diamonds,
gold in commercial
diamonds
products, don't you?
Yeah, it's same as diamonds. Yeah, I mean, you can argue both sides of the coin here.
That's quite a good pun, actually.
Diamonds are
Yes,
forever.
I thought you'd appreciate it.
The gold's forever,
Mark, go on.
Gold is forever as well, isn't it?
Gold is what?
It's forever. Base metals, they never change. They're always there.
That's
You
correct.
just change
yes.
its state, it never goes.
Right.
Although it's interesting.
Like platinum.
Oh,
Go on, Gabriel.
yes, a question about intrinsic value. It's related, or is directly related with the scarcity.
Mm-hmm.
Scarcity, yes, and commodity, isn't it?
So you're right that sometimes something can have a higher market value because of the scarcity value of it. So,
Let's say Bitcoin.
Mm-hmm.
Yeah.
So
or oil, then market manipulation, OPEC, and
fiat money is manipulated by the government.
Yeah,
QE. Has scarcity value. Yeah, QE
and QE and dilute it.
Yeah.
So I think we're struggling to find anything with true intrinsic value. Then is that fair?
Yeah, I think there's value to people. I may see a value in buying an NFT. I like it. I like the art. I want to buy it. I've got a spare 100,000. I'd buy it.
Mm-hmm.
You may look at it and say, "Hey, Stuart, you're stupid." To me, no.
And you can kind of extend that. It doesn't just have to be a token. It's the whole thing. I found it interesting when crypto tokens and the world of real art, as I would describe it, start crossing over. You think about, what is the intrinsic value of a Canaletto or a Dali or a Van Gogh or whatever. Ultimately, it's the base materials of the painting kind of things. It has very low intrinsic value, but it can have a very high market value. And to me, I look at some pieces of art and I'm astounded they're even given pride of place in an art gallery. But that's my taste, and so I've got no interest. And actually, I found it fascinating as well. I got involved in artwork and crypto and NFTs a while ago. And a lot of the art market, fascinatingly, again, it's not backed by anything. It's people's perception of value. And actually, some tokens and some fine art operate the same way, that they're actually based around bragging rights. It's not about the fact that a piece of art is beautiful or incredible. It's the fact that you can prove you're the owner of it. And this is why there are some pieces of art that people buy and they never show. They stick it into storage or it's kept away. And it's just the fact that they can say that they own it is what they ascribe the value to. And I was blown away. There was an art gallery in London at one point, and they were actually auctioning off pieces of art by artists where you didn't even know what the piece of art was beforehand. You simply knew it was by a particular artist. So if it was a particular upcoming artist or whatever, then people were making bids on it, having never actually seen the artwork. They'd never seen the picture or anything like that. And they were making bids simply on the bragging rights to be able to say that they owned that piece of art by whoever it was. So and NFTs might seem crazy at times, but they're no different to the real world either. Is that it? Have I silenced everyone with that as a thought?
No, it's good.
Mark,
Novelty value, eh? Novelty value.
Yeah.
Yeah,
Mark, go and shoot.
No, I was going to say that any piece of art is only worth what someone is willing to pay for it. And there's a tremendous amount of FOMO. If I go to Christie's, for example, to an auction, and you've got people bidding from the other side of the world on the phone, and they're willing to bid 105 million, 115 million. Do I hear the next? And they may or may not have seen the art, but what they're doing is speculating on a perceived value. And I think that perception is where the value of crypto comes in. Rather than intrinsic, I think it is more perceived.
Completely agree. And I always say that, the price of something is simply at the point at which you can find a buyer and seller who can agree on something. And that's where I always find it interesting as well, that you hear people saying, oh, I bought this for a bargain price. Well, in order to have bought it at a particular price that you thought was really low, that means someone else thought it was actually worth getting rid of at that price. So both of you can't be right. So it certainly introduces some interesting dynamics there.
Yeah, as long as it was right for you at the time, though. That's the main thing, isn't it? I mean, that's where a lot of this, like classic cars and things, isn't it? It's just,
Yep.
The value of it when it was originally sold is like 20k, but now, like, Ferraris and things, GTOs, 30 million.
Mm.
And you think, it's only a 10 grand car when it's built.
Yeah. I think it kind of illustrates as well that people often talk about the craziness of the crypto market, but actually crypto quite often is simply reflecting stuff that goes on in the real world. It's just a variation of it. And this is where when it starts coming down to people always come back with, I get this all the time with new people coming into crypto space. Oh, but it's not backed by anything, is it? It's like, nope. And neither is most of the things that you buy and sell as well.
Most of the government fiat isn't backed by anything. It's backed by the US government money is backed by the faith of the US government.
Yep.
Yeah, because they don't have the gold standard, do they? Yeah.
They don't have anything. Yeah.
The thing that scares me, though, is in cryptos and tokens and things, is the fractional value you're getting. You don't realise you're only getting a millionth from something. Whereas when you get...
Mark, I think you're going through a tunnel at the moment because we're losing you. But I got the concept that with some crypto you only
like
get a fraction of something.
Or a pound, sensible. Whereas, if you're doing a couple of billion tokens, you have only got a billion something.
Mark, I think with you being on the train, we're losing you at the moment. You're kind of breaking up. So while Mark's heading through the tunnel, any other thoughts? Stuart, anything else happening?
No, I saw a lot of liquidity go out of the market last week. Other than that, I forget which foreign country issued I think it was an African country issued a token and it dropped after 2 days.
But that may be, is that not the Argentine one we're talking about?
I don't know, not the Argentinian one. I think it was an African country. And it took about 7 billion out of the market.
Oh, wow. Okay.
So liquidity was real low at Thursday.
Okay.
I didn't look on Friday.
Okay. I didn't see that because it's interesting. I think we were talking a few weeks ago. It's slightly different, admittedly, about the Nigerian CBDC, the eNaira, which was launched a few years ago and didn't gain market traction. And I think they're trying to relaunch it in some way. Well, I'm guessing that's different because cryptocurrencies and CBDCs are different beasts.
Yeah.
Okay. Interesting. And Annie, you're being quiet today. You usually have some questions by now.
I've been enjoying the conversation. So I have thought about tokenization. So you guys have started the conversation, kind of thinking, is that a direction that we can go in this call, do you think?
I have seen, and I've only been involved and interested in the crypto space since 2014, 2015, so 10 years or so. I've seen in that time it go through multiple cycles of innovations and changes in there. And tokenization is one that I think it's gone through at least 2 cycles of, in fact, possibly 3. So there was the ICO tokenization phase, which was where companies suddenly found out that by launching a token, you could use that to raise funds for a new project. And that went through a craze in 2016, 2017-ish, I think it was. Then there was a general NFT craze where people were creating NFTs, which didn't really mean anything else for a while. That didn't go anywhere. Then you had the kind of like Bored Ape Yacht Club NFT phase, where you had a bit like Pokemon cards, people launching crypto tokens that represented like gorillas or creatures or whatever. That was certainly a phase that went through. Then I think the latest phase, I would guess, is tokenization of real world assets. So this is where you see almost every week someone launching a real estate token or a precious metals token or something like that, where they're trying to represent real world assets, fractionalized and tokenized. And I think that's probably the current cycle that we're going through. So I've seen tokenization go through about 3 phases so far within the crypto cycle.
Okay, so then just now when you were mentioning about the African country shut down a token which costs a lot of money, I'm just kind of curious then.
No, they didn't shut it down. It went up and then the value dropped. So it pulled money in for the issuer and then the value dropped.
Okay, so is that affecting people who use it as I don't know, transaction for gold or something, or
the value of it is very, very low.
okay.
I think it was last week because the market was very pathetic Monday, Tuesday, Wednesday.
Could it be this one? Just as we were talking now, I pulled in a thing that was a launch during the week or last week of the Central African Republic.
That was it, yes.
Okay, so there's no from about
their coin.
Yeah,
that was the one.
This is it. There's so much of this stuff going on these days. I just can't keep pace with it.
It's like a Nigerian lottery, isn't it?
Almost literally. Yeah. So, well, they launched that last week by the look of it.
Yeah.
Launched, just car meme coin. So Central African Republic.
Yeah.
Trading at 22 cents on Monday. I will go away and find out what it's trading at now separately. So.
Okay.
So is it, just out of curiosity then, I thought token is not like Bitcoin. That's what I was thinking. Because you would use token almost like you can change your house title deeds into token. So, it's not really a form of Bitcoin that I thought about.
Well, Bitcoin is totally separate from everything else.
Yeah.
That's just a token, if you will. And we probably need to define what is a token and what is a coin, and what is utility and what is speculate or a speculative asset.
So I'm kind of curious then why we see this news that Gary has just shared. It says something 22 cents on Monday. Would we expect token to be traded in the same way like Bitcoin? I thought it's two different things.
I think the behavior of it may be different. And in terms of it being two different things, I think Stuart's absolutely right. It's worthwhile actually offering a definition of what cryptocurrency is versus a crypto token, because they are by their very nature different. So fundamentally speaking, a cryptocurrency is the method by which a blockchain network gives an incentive to its market to secure that network. So the Bitcoin blockchain, for example, has a cryptocurrency, a native cryptocurrency called, unsurprisingly, Bitcoin. And Ethereum has got one. And you can see they're not very creative, some of these people. The Ethereum network's got cryptocurrency used to secure the network called Ethereum. And that isn't always the way it works, but that's pretty close on it. So a cryptocurrency is, strictly speaking, the mechanism by which you give a financial incentive to secure a network, which sounds really, really boring and really, really dull. But what it means is that it is linked only to one blockchain, and it's generally well recognized and can be tracked and traced now. A crypto token is a programmable token. It's based on what's called a smart contract. So this is a bit of software, often written in Solidity if it's on the Ethereum blockchain, for example. And so you will get multiple tokens that kind of look similar to cryptocurrencies. They can be traded on crypto exchanges now, but they are in fact smart contract-based tokens that can all run on the same blockchain. So I mentioned before on Ethereum, the Ethereum native cryptocurrency is Ethereum, so ticker tape letter ETH for that. There are also many NFTs or other crypto tokens that also exist on Ethereum, and they're using smart contracts on that. So the nature of them is slightly different by the fact that they're programmable now. Bitcoin is a blockchain that doesn't typically have native programmability available to it, which means that you don't get generally crypto tokens based on Bitcoin or based on the Bitcoin network. They're usually based on a programmable blockchain like Ethereum, Solana, or Cardano, to name some of them. So, but by their very nature, they are a little bit different. But to the end user, many of them don't care. All a lot of people are interested in is, if I buy this at this price, am I going to make money on it? And that sadly is it for a lot of people. So this is why they'll look at charts and they'll see pretty graphs and kind of patterns in the graphs that they can see, which makes them think that something's about to go up, down, or sideways or whatever. And they don't.
To the moon.
Yeah, that's right. Yeah, and actually, a lot of the time they don't care. What's the purpose of the token? What's the purpose of the blockchain? All they're interested in is, am I going to make money out of this? Can I buy it at price A and sell it for more?
How many X can I get out of it?
Yeah. Well, which is why you get a lot of it. It's like, to the moon. It's like, I'm going to 10x it, 100x it, or whatever. So the Trump coin, in some ways, was exactly that. That went up, I think it was 27,000% in total, which means if you've managed to get in early and put a few dollars in, you'd have done very nicely. So the market really, a lot of the time, is made up of I'd kind of describe them as innocent bystanders. The people who don't really understand anything about the underlying technology or the token or whatever. All they're interested in is, can I buy it at one price and sell it for more? Then you've got the institutional organizations who are looking at it a little bit more strategically, but ultimately, again, are looking for something that if they buy it at X, they can sell it for X plus whatever. So the nature and behavior is the same. The other area where it makes a difference as well is in legislation. So you will find different countries, the regulators actually take the time and effort to define what a cryptocurrency is, what a crypto token is, what a stable coin is. So a stable coin is effectively a crypto token. So it's a programmable token, but it's matched with a physical an asset underlying it, whether that's a fiat currency or gold or whatever. So a lot of the regulators, the Swiss were probably one of the first, so they published some good guidance on the difference between cryptocurrencies, which tend to behave like money, and crypto tokens that tend to behave like speculative investments or speculative purchases. And I need to be guarded when I use the word investments, because this is not a session for offering financial advice, blah, 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 blah. Does that help, Annie, or does that further confuse things?
Well, it helps in some ways, in the sense that I think, from what I understand, is token is almost just like Bitcoin, in the sense that, you have a starting price, the price changing every day or every hour or whatever it is, just like Bitcoins. But if people actually intend, or if the idea of the tokenization intend to also deal with things like house title deeds and that sort of thing, surely, I'm not quite sure you want that be changing every day, is it? I don't know. I mean, if the house is, when you bought it 10 years ago, it was £10,000, and then by now it's in millions. You just want that to be kind of, it's in millions. It's not depending on this, token keep changing values and make your house price going further down than when you first bought it.
Let me add something there, because I've been involved in one of these RWAs with real estate. And Anthony Abel in the UK has started TPX. And I'm an advisor to them. Now, the way that it works is, let's say you own your house free and clear, and it's £500,000. You offer 49% of that to investors who will give you token or coin. And they are free then to accumulate those and swap them, speculate on them, or what have you. Now, you keep up the value of your house, you pay the taxes, you've got the cash. So you've just got 249,000 because of these fees, and you only sell 49% of the house. So my maths is a little bit out. Their claim to the house comes back to you when you sell the house, and you sell it for $1 million. You would only get $500,000 because you've only got 50%. And the holders of the token or the coin, however they've expressed it, would share in that cumulative accumulation of value. Now, just sitting there holding a coin is not going to do me any good. So what I would do, if I bought half of your house, I would now start looking in Dubai, where it's a very strong market, and I would want to see if I can buy portion of a house in Dubai. And so I'm hoping with the money that I've laid out on your house, I've now got tokens back, and I can use those tokens to buy Gary's mansion in the Palms, or a portion of it. And so now I'm speculating on that, but I actually would own it through a title deed or partial title deed. I'd be registered as a first or second lender. So that's how the money goes round. And if it works, especially in the UK, it will change the GDP by about 2% once it's fully working, because it would free up a lot of capital to people. And I could also say, if I've given you £249,000 and I've got all these tokens, I could go into WH Smith if they're still open, and I could buy a newspaper if they still sold them. And just deduct it from my balance, and I'd have less, if they traded in it, I'd have less to speculate and buy somewhere else. But effectively, that's what I could do. Does that help explain the real world asset classification for houses?
So let me summarize it just to make sure that my understanding is correct. So what you're saying here is, with the tokenization, someone can be like a shareholder of different properties. They can be an investor. So if let's say,
just like a bank, just like a mortgage or a bank.
So you mean even every individuals can be like a bank in their own rights, rather than necessarily having to go through the bank and have a mortgage taken out?
Correct. Right. So if you sold that £249,000 worth of equity to 200 people, they would all have 1/200th of £249,000. Now, what they would do is you do it through a SPV, a special purpose vehicle, and you would register that, or you'd register it through another trust or what have you, so that the land registry is not constantly updating every 30 seconds if someone is trading.
Yeah, that is the other thing, isn't it?
So you keep that on a blockchain, and so you do the reconciliation every day, probably.
Oh, I see what you mean. So the title deeds would also be in the blockchain, so it's not with the registry. And then
you would register it. So the SPV, for example, would register it with the registry. Okay. So when you go to sell, whoever is doing the conveyancing would say, Annie, here's yours, and this SPV is yours. So now the SPV has got to say, okay, let's go on the blockchain and see who at that moment in time owned what, and then distribute that out.
Right. Understood. Wow.
Okay.
Thank you.
This is where, again, we start going into the whole range of definitions of what things actually are. Because quite often we use these terms and expressions without thinking twice about it. But the really obvious one is the definition of money. So money has got an economics definition, and I can't quite remember all of the attributes, where it's that it can behave as a store of value, which is a bit like precious metal or whatever. You stick it under the bed and you can use it. It can be used as a means of exchange. So you go into Starbucks, I pay for a cup of coffee with money. It can be used as a accounting unit. So the very fact, if you look in company accounts and they'll be expressed in the P&L and the balance sheet in dollars, pounds, pence, and that kind of thing. But also can be used as a definition of value, unit of value for buying and selling things, which is why it is, if you go into Starbucks in the UK, all the prices are marked up in pounds, because that's the denomination value in the UK, or dollars in the US or whatever. And it's very rare to see things priced in crypto. So a lot of economists claim that because of that reason, it can't be money. That said, I think I've mentioned on this session before now, I have actually bought a burger and fries with Bitcoin, and it was priced in a Bitcoin price. So you got this whole thing of your definition of money. Then you got your definition of what are commodities, because we're mentioning gold, we're mentioning real world assets, all this kind of thing. And you got the whole thing of like, precious metals are obviously commodities because they're nice and shiny and people like them, that kind of thing. And then you get things like other type of assets, and Stuart was mentioning property as an example, and that's where property is always an interesting one. And I think I often say I've seen at least 60 tokenization projects for property projects now around real world assets, and it's fascinating to see them come and go, because they all start off with a very simple notion of, oh, well, you buy a property, you slice it into little pieces and affect the ownership, and you distribute it out. That doesn't work. And it doesn't work for a number of reasons, not least of which is that in the UK, you're not legally allowed to have more than a certain number of owners of a physical property or land. And a lot of people don't realise that. So this is why, to work around that, as Stuart correctly described, and how TPX, I think, do it, and a number of others do it, is you create what is called an SPV, or a special purpose vehicle. So this is a separate legal entity that is set up, and it's that legal entity that actually owns the asset. Okay, so as Stuart said, you buy a house for £250,000 or whatever. It's this special purpose vehicle that owns that asset, and so it is the owner. So the ownership of it never changes after that. So you don't have to keep going back to land registry and re-registry title, this kind of thing. But what you can do is effectively create shares in that special purpose vehicle, which are effectively fractional ownership of the underlying asset. So that's quite a neat way of avoiding having to pay land registry fees and capital gains tax and all this kind of thing. You then hit more legal problems. And if we had Anthony on, I'm sure he would go into it in depth, and he has done, because it's an area he's got a great deal of knowledge about. Because tokenizing real world assets means you cross a whole range of challenges. First of all, you've got the challenge of the regulation of whatever the industry is. So as I mentioned, things like, property, title deeds, land registry, and that's got complexities to it. Then you got the complexities of crypto and the nuances of that. Then you got the complexity of money and financial services, because as soon as you start tokenizing something and offering it as a partial shareholder, it potentially becomes what's known as a collective investment scheme, or any other number of things as well. So Anthony, again, has elegantly described in the past how it is that tokenization of real estate in particular means that you end up crossing over. It's a bit like if you draw a complex Venn diagram of circles, and there's about 5 different circles that you overlap in, which is why most projects in that area fail. And it's great to see TPX spent a lot of time getting a lot of this right, and seem to be on a much better journey as a result. So, yep. So Annie, it all comes down to definitions.
Yes, I understand. Actually, you just remind me of something else, because earlier on in the discussion, I've heard you guys talking about piece of art and things like that, and it actually kind of bring to mind to me, as for someone that has been to different places and exhibitions when I was in London, is that apart from gold, which people would accumulate, people actually also accumulate wines. Mm-hmm. Interestingly, the longer the wines, the more value it is somehow. Arts as well, people do that, the investment of arts, because they believe that piece of art in the future is going to cost more, it's going to give them more money. So it's almost like they can get money back out of what they invested. So my other question, when this is separately in regard to what you just said, so we know that with fiat currency, when you buy a house, you go to the bank, you ask for a mortgage, and every month you have a repayment terms. Now the government, in order to help people to get to the property ladder, what they have done is they say, oh, let's have shared ownership. Mm-hmm. Okay, so what that means is, So half, you might pay half of it. So you own half, the other half. So what happened there is you pay 50% of what you own in mortgage to the bank. You pay the other 50% in rent to a housing association, right?
Yep.
So then if everything becomes tokenized, okay, so you can have 200 people owning, one.
So it's exactly the same, Annie.
So do you still pay these people something every month?
No, that's the benefit of it. That's why it would be easier, but they're not going to take a chance with someone who doesn't own anything. But essentially what the government has done there, where they've done equity, it's called equity share in the United States. And what the government is saying is that, okay, we will give you a loan for this to help you on the ladder, but you have to help a housing society or whatever. So you're actually paying it. Now you can actually pay on that, or let's say you have a rich benefactor. You have some sugar daddy that says, Annie, I'm going to give you $250,000 towards your $500,000 flat. You don't have to pay me anything, but when you sell it, I want 50% back. It's exactly the same.
Just on that, Stuart, normally you'd be paying rent though, wouldn't you? To a housing association, you rent. You have to pay rent on the section you don't own. So if that was a token, you would be paying a fee on a token, wouldn't you? If it was, it depends what the arrangement is, though, isn't it? That's the thing. So
it depends on the arrangement.
Yeah. That's all securities, isn't it? Really, and how it's managed and.
Yeah, it's basically because otherwise, if you gave it away free, or you said, okay, there's a deferred period, which I do in investments sometimes. Everyone would take advantage of the government because the government cannot track anything other than TV licenses. I think even that they're not good at.
Really? I didn't know that. But in any case,
they don't enforce them.
No sugar daddy interest here.
No. Given that as a silly example.
No, but it depends if somebody's prepared to take the punt, isn't it? And that's the thing. In some places, they will. Like these where you get the drawdown on your house, the age. When you're old, you can sell off half your house.
Oh,
and they don't. You don't pay that, do you? You get a fixed amount of sum, but then they've got. It's the same as you mentioned before. They then own that percentage going forward, don't they?
Correct. Yes.
It's also known as equity release, I think.
Yeah, equity release. That's it.
Where you've effectively sold the equitable value of the property for a return. There's an additional complexity as well, which is worth throwing into the mix as well, where you've got something, as Annie says, where it's a mixture of half ownership, half rental. What some companies sometimes do is people don't realize that actually future revenue streams can be monetized in themselves. So much like how you can buy a Mars bar or a cup of coffee, you can also buy the rights to the future revenue of something like rental. It's a process called securitization. And this is what finance companies and banks and that do a lot of, where effectively, if you've agreed to rent something and the rental agreement is like £1,000 a month for the next 20 years, then they can sell the rights to that future revenue stream at a discount in some way. And so that means that they effectively get, if it was spread over 20 years, they might get the equivalent of 15 years of rent paid up front as a lump sum. And they then sold that off. Again, you can tokenize that. And it's interesting. I know some companies who are looking at tokenizing securitization of revenue streams, because what I hadn't realized, even though I have been involved in securitization programs, is that a securitization is a non-regulated financial instrument, which is fascinating.
Right, but I believe that factoring, which is almost the same but on a monthly basis, that's regulated, isn't it?
Yes.
In the UK?
Yeah.
But long-term streams, so for example, my uncle died, left me $10 million, but he's paying it out over the next 10 years. Someone may be willing to give me $5 or $6 million, but for that revenue stream. And I go away happy man.
It's similar to how actuaries will do a forecast on your expected life and buy your
Exactly
pension.
the same.
Yeah,
Exactly the same. Yeah.
Yeah. So it's all fascinating stuff, and this is a game where I find it interesting how people are coming up with crypto products that effectively replicate a lot of this traditional stuff already, and quite often they fall foul of it because they don't quite understand the traditional financing regulation, and they don't quite understand the crypto regulation, so they fall foul of two lots of regulatory constraints. So interesting things.
Lots of it does need digitization, though, doesn't it? That's the trouble. Lots of it all still very paper-based and everything, and
Yeah,
you can understand people trying to make it more efficient and streamline it, and in a way that gives people more access, doesn't it? 'Cause it comes back to the fractionality of it and things.
yeah.
People are prepared to take a smaller chunk of risk. And
You're right, and Annie was giving a couple of examples earlier on about fine arts, which I was involved in for a while, around tokenization of paintings, that kind of thing. And she mentioned wine as well. So it's interesting. I used to work for the world's largest wine producer, who I used to jokingly say that we didn't have a vintage date on it. We had a sell-by date because it was generally the lower end of the market, but it was high volume. But you do get people who will tokenize fine wines. And again, as Mark mentions about digitizing the process, the interesting thing there is how do you digitize wine? Because you can put a tracker on the bottle, but that doesn't stop someone from drinking the bottle and filling it up with something else. And you know, there are all sorts of cases. Again, it's fascinating in fine art and fine wine. There's lots of corruption and there's lots of illegal stuff going on. There's lots of counterfeiting going on, which is again where, you know, a blockchain solution sounds brilliant. Of, hey, you know, we can track and trace the wine from its production right the way through to its consumption. So this was similar to what we talked about a few weeks ago about the provenance of goods and how a blockchain can do that. The problem is, it's like anything else in IT, of garbage in, garbage out, that these blockchains and the tokenization are only as good as how you're capturing the data in the first place, and then how you're monitoring it. So there's a good example of both of those products, in fact, being put on a blockchain with a company called Everledger, who were a startup from, I think, around about 2016, 2017-ish, I think now. They actually came out from a hackathon. And
yeah, it's a Kiwi girl, isn't it? Can't remember her name, though. I
wouldn't call her Kiwi because she's Australian.
Oh, she's Aussie, is it? Oh, okay.
Yeah.
I met her a few times in Shoreditch at Barclays.
Yeah, she's a good laugh. She's really good fun, but I definitely wouldn't call her a Kiwi.
But the trouble with that is there was nobody would pay for it, was it? Because obviously the beers were quite interested in tracking, because it did 40 points on a diamond, which was actually quite a good way of authenticating it, wasn't it? So that they were quite prepared to pay for it. But then once it was sold, they didn't care about it. But then the insurance companies, obviously, that they were interested in provenance as well. But until it was put under contract, they weren't bothered. So in a way, she couldn't get anybody to actually take it on, could she? Because it was a product without a use case, you know, an end-to-end use case. That was the trouble.
It's kind of interesting. I always used to describe Everledger as the poster child of crypto and blockchain, because it was a good example of the concept, at least, of putting stuff on a blockchain. And for those who aren't familiar with it, so the idea was when a diamond in its rough form was first mined, then they would examine it, and as Mark said, you know, a diamond has got something like 40 different attributes, like, you know, how clear it is, how much of a reflection there is. There's all sorts of other stuff. I always used to think a diamond only had one attribute, which is how much it is. But that's actually the least of things. And so what they did was, when it came out the ground, they do an inspection of it, and then they'd record those unique characteristics. They'd create a cryptographic hash of it, in fact, and they'd record that signature on a blockchain. and then the diamond would go for initial polishing in Mumbai, in India generally, and that would alter some of the attributes of it. So they do another cryptographic hash of it. Then it would go to Rotterdam for final polish, and again they do another cryptographic hash. And then it would go to somewhere like Covent Garden in London, where a jeweler would take the diamond, would set it in a ring, and it would go on sale. And what it meant was quite neat. They actually developed an application on a mobile phone, which meant if you were buying a diamond ring, then you also had this mobile phone app, which gave you the full provenance of that diamond and its history, and you can see the traceability in there. So from a traceability point of view, really, really interesting. And the diamond market's interesting as well because it has certain constraints. There's a thing called the Kimberley process, which is about preventing conflict diamonds. So diamonds that are being produced in war zones are frowned upon. So the Kimberley process means that you had to provide evidence of where the diamond come from. So it fitted really well for it. So in fact, Mark, I'd argue in some ways it had a really good use case and a really good demand. The problems, I think, if I remember having spoken to Leanne, so the CEO is Leanne Kemp, was that they had some internal challenges aside from actually the market problem and that. And one of the other things with diamonds is that actually it's a market that is completely dominated by very few players. So De Beers is a major influencer. And so you have to get on board with these things. Just like we were talking the other week about shipping and transportation and tracking of containers. A lot of that, if you think about, if anyone asks you for a container company, you'll quite often say Maersk Shipping, because you see Maersk all over the place. They're one of the bigger ones, and Evergreen.
Yeah.
And APL cancelled a blockchain project with IBM as well.
Mm.
Yeah, I was going to mention that's Maersk as well. Maersk, they've
That's
stopped it.
Maersk, yeah.
Yeah, because it was all about. I didn't realise, but their bill of weigh didn't. Sometimes the ship would already be at sea for 3 months before, and it hadn't even been completed. And you just think, wow, like, how can they let it sail when they don't even know what's in the containers? It's just, but apparently that's the way it works. And it was like a technology that, so we thought blockchain was ideal for that. But then, it didn't need blockchain. All it needed was obviously like an immutable database or shared ledger. It just didn't really need a blockchain. I think that's the trouble.
No, the real reason was it couldn't keep track of things. With the smart contracts on the blockchain, it was related to one container. And what they realized is that in containers, you often have shipments from different people. And they weren't able to control those because they didn't have the asset base. And you can't do it with smart contracts because they're non-composable. And we went through that with them, and cool. We're talking with them at the moment, and we're probably talking with IBM as well. Well, we'll be very shortly.
It's fascinating because, again, I was mentioning about how the crypto and the blockchain market go through cycles, and it does seem at times it's cycles of deja vu. That with each iteration of the technology, the same ideas come through again. So the whole thing is about provenance, traceability in there. So if you think that it's ineffective to track a container because you don't necessarily know what's within the container, there was actually a blockchain project which was tracking ships. So this isn't tracking the container, this is just tracking the ship. And that was a project called InsureWave, which again involved Maersk, and I think it was Aon, XLCat, and a few other insurers. Because the shipping market, I find fascinating. I used to work for an oil trading company, and we used to charter what are known as VLCCs. So these are very large crude containers. These are massive ships filled with barrels of oil, whatever. And when I worked for the commodities company, we would know exactly where every ship was to within 15 minutes. So we knew everywhere in the world, 15 minutes, what speed it was operating on, which direction it was going at, everything. We were tracking them incredibly tightly. When I moved into the insurance world...
Is that until they turn their transponder off and nip into Iran?
Nah, there is stuff about that.
Yeah, my cousin works for a club, marine club.
Yep.
They get it all the time.
Yep.
It's just you just couldn't make it up.
But what you find is, this is where I found it fascinating. I then moved into the insurance sector, where they were insuring these ships. And you'd have thought, knowing exactly where a multi-million-pound or multi-million-dollar crude container ship is, you'd want to know where that is for the insurance risks. Whether it's risk of piracy, theft, bad weather, all this kind of thing. And I was astounded that some of the insurers didn't even know the vessels that they were insuring, let alone where they were. So again, there was a great opportunity. You stick the vessels on a blockchain, you stick the voyages on a blockchain, all that kind of thing. But as Mark says, then they go and switch the devices off. There are ways around that. But it shows, if you can't even safely and securely track a 90,000-ton ship, then tracking and tracing a bottle of wine, it's in a different league. But people try it every few years. So
Was it the other thing about Everledger was fraud, wasn't it? All the Chinese synthetic stuff, and that was a big worry then, wasn't it? And
it was designed to prevent it, because if you could prove that the diamond had actually come out of a mine, in South Africa or somewhere, then you could prove it wasn't synthetic. Yeah. And synthetic diamonds are going to be interesting in the future, because the sheer quality of them is now so good. It's like, it used to matter as to whether something was a laboratory produced synthetic diamond or whether it was a genuine one that had come out of the ground. Actually, they all look very shiny to me. So
it's perfect, doesn't it?
Yeah.
You can't tell whether it's perfect or slightly not perfect.
Exactly. So fascinating stuff anyway. So
it was a good one with meat as well, wasn't there? There was RFI tags.
Yep.
On meat in a blockchain, you can fully provenance the meat.
Yeah, and in fact, I think that came about where in Ireland they were doing some track and trace around, I think it was beef burgers or whatever, and they actually did some DNA checking, and they discovered that the particular breed of beef was a breed called horse.
And yeah, exactly.
And that causes a few. So funnily enough, the Irish Dairy Association, I think it was, actually did a provenance project a number of years ago, exactly around that kind of thing. So yeah, but yeah, again, it's the how do you track and trace a cow? Can have problems, and with some of these things, there are ways where you either simply tag it, but then someone can take the tag off the animal, or you can do stuff. There was some research being done about things like injecting them with a unique RNA or whatever, chemical, something
like the DNA spray stuff.
The TRUMP, yeah. So there's all these things. So I love it when I talk to people about these things and realise that I've had these conversations 5 years ago. It's like, oh, someone else is coming up with this. So.
Well, my friend was getting ripped off. They're up in Kendal, and they had Aberdeen Angus. And they were taking them. They didn't have their own. They were taking them to the cooperative slaughterhouse, which does the cutting as well. And you're expecting like 800 pounds of something back, and you get it back, and it's like 650. And it's very hard to challenge them on that. It's just so yeah. Even though it could be bagged up with RFI tags and things, if you haven't got trust in the people that are doing it to start with. So
exactly, and that's where it comes down to where you capture the data and how you ensure that the data is being entered accurately.
And the trust, trust again.
Exactly right. But folks, talking of time, I'm afraid we are out of time. We've been on for an hour. Fascinating how it is that we can cover these kind of things and an hour flies by. So just wanted to thank everyone, Annie and Stuart and Mark and Gabriella. Thanks for joining us. Thanks for the contribution. Really enjoyable. Really, really interesting stuff as always.
All spinning off the Argentinian coin. And we still didn't get to it. So it's a novelty value, basically. Is that what we've come to?
Exactly right. So folks, going to have to head off. Have a great day, everybody.